Good morning, friends. During this period of audit, we received a lot of queries relating to preparation of computation of income for an organization registered under section 12A or 12AA for income tax purposes. So today I will try to resolve this issue and develop an understanding by taking you through the practical derivation of the computation. So before moving on to the topic, let me first give you a brief of what is a computation of income and why it is prepared. Computation of income can be understood as a systematic presentation of all the income received by the organization during the year, which you can say as source of funds, and the expenses incurred for the purpose of achieving the objects of the organization, which can be said as application of funds. It is prepared in order to ensure that the provisions of section 11 and 12 for tax exemption of applying minimum 85% of the total income, I repeat, it is prepared in order to ensure that the provisions of section 11 and 12 for tax exemption of applying minimum 85% of the total income has been fulfilled by the organization, and if not, whether the necessary accumulations have been done in accordance with the provisions of the said sections. I would also like to point out here that it is quite evident from the provisions laid down in section 11 that the computation has to be prepared on cash basis of accounting irrespective of the method followed by the organization, that is mercantile or cash. So let's begin. Suppose the total income of the organization is rupees 50 lakhs, the breakup of which is as follows: voluntary contribution rupees 35 lakhs, interest rupees 5 lakhs, other income rupees 10 lakhs. So the total income of the organization is rupees 50 lakhs. Here I will again like to take a pause and remind you of few things. Don't forget to consider those receipts which are directly routed through balance sheet and not reflected in income and expenditure account. Now what those receipts can be? Those receipts for which separate fund is maintained by the organization, and so the income and the expense related to such nature of income is reflected directly in the balance sheet. One should also reconcile the income with that reflected in Form 26AS and consider the same in the computation if not already considered in order to claim the entire TDS deducted. Corpus donation will also initially form part of the total income but gets exempt later in the computation under section 11(1)(d) of the Act. Statutory deductions from employees such as PF and ESI or TDS deducted from contractors, professional, rent, etc. or advances received which are in the nature of loan and is to be refunded does not form part of the total income. However, receipts in the nature of income which is received in advance has to be considered in the total income in the year of receipt itself, though it might not have been routed through the income and expenditure account in case organization is following accrual system of accounting. Similarly, the income which relates to current year but was received in the earlier year and thus routed in the income and expenditure account in the current year should be deducted because it might have already been considered in the previous year itself. Last point which you have to remember is, apart from all the above, inter-unit transfers, that is transfer within the units of the same society or trust, should also be not considered in the total income. So let's go back. The total income derived after considering all the above points during the year is rupees 50 lakhs. Now let's compute the application of funds, that is expenditure done during the year. I have a bit different way of computing the application of funds for you. So let's see. First, take the total of expenditure side from the income and expenditure account. I repeat, take the total of expenditure side from the income and expenditure account. Then deduct depreciation, as it should not be considered as application according to the provisions laid down in section 11 subsection 6 of the Act. Then deduct the amount of surplus, that is excess of income over expenditure, which is reflected on the expenditure side of the income and expenditure account. Please note here that in case of deficit, no adjustment is required as we are deriving the application amount from the expenditure side and deficit is reflected on the income side of the income and expenditure account. Fourth point which you have to remember, in case of those organizations following accrual basis of accounting, you need to also deduct the expenses for which payment has not been actually made to the creditors or suppliers. I repeat, in case of those organizations following accrual basis of accounting, you need to also deduct those expenses for which payment has not been actually made to the creditors or suppliers by the end of the year. However, correspondingly, don't forget to add those expenses for which payments have been made during the year to the supplier, even though such expenses was incurred but not paid for in earlier years, since it would not have been considered as expenses in those relevant years. Now comes the most important part of the expenditure, which is the capital expenditure. Of course, any addition to the capital assets should be considered as application in its entirety, and this is one of the reason depreciation is not allowed as an application as per the laid down provisions. So after considering all of the above, let's say the total application comes to rupees 30 lakhs. So let's have a look at the final figures. Total income is rupees 50 lakhs, total expenditure is rupees 30 lakhs. Now as per the provisions of section 11 and 12, 85% of the total income, which comes to rupees 42.5 lakhs, should have been spent in order to claim tax exemption. So basically, the organization seems to have underspent by rupees 12.5 lakhs. So I repeat, how I derived rupees 12.5 lakhs? The total expenditure was 30 lakhs, and as per the provisions of section 11 and 12, the organization should have spent at least rupees 42.5 lakhs. So the difference between the 42.5 lakhs and 30 lakhs comes to rupees 12.5 lakhs, which is the actual shortfall for that particular year. Now here you have two options. Option 1, accumulating the amount as per explanation to clause 2 of section 11(1), which means you undertake to spend the shortfall of current year in the immediately succeeding year. Option 2, accumulating the amount under section 11(2) of the Act for certain specified purpose, which means you undertake to spend the shortfall within a span of 5 years from the year of accumulation. So I am repeating the two options again. Option 1, accumulating the amount as per explanation to clause 2 of section 11(1), which means you undertake to spend the shortfall in the very subsequent year. Option 2, accumulating the amount under section 11(2) of the Act for certain specified purpose, which means you undertake to spend the shortfall within a span of 5 years from the year of accumulation. And it is clear that for option 1, you don't have to specify any purpose. Please note, the rest 15% is statutorily allowed to be kept accumulated under section 11(1) small a towards the object of the trust and cannot be subjected to tax under any circumstances. So there are 3 sections which are involved. Section 11(1) small a, which is statutory accumulation of balance 15%. Explanation to clause 2 of section 11(1), which is the amount you undertake to spend in the very subsequent year. And section 11(2), which allows you to spend the shortfall of the current year within a span of 5 years from the year of accumulation. So in our example, the amount accumulated under section 11(1)(a) comes to rupees 7.5 lakhs, which is 15% of 50 lakhs. And for the balance rupees 12.5 lakhs, you can opt either for option 1 or option 2. Now what happens in the next year is more important for you to understand. Suppose in the next year too, the amount of income is rupees 50 lakhs. But let's change the expenditure amount to rupees 45 lakhs, which comes to 90% of the total income. So although it seems that the organization have been able to meet the criteria of spending 85% of the total income because it has spent 90% of the total income this year, but it is not so. In our previous example, which was the first year, if we have accumulated rupees 12.5 lakhs under option 1, the amount should have been spent in the subsequent year, which is the current year we are talking about now. So actually this year's expenditure should have been 85% of rupees 50 lakhs plus the shortfall of the previous year, which is rupees 12.5 lakhs. Considering that rupees 12.5 lakhs have been spent in the current year and thus adjusting the same from the total expenditure, again this year's application falls short of 85% by rupees 10 lakhs. Wondering how I derived rupees 10 lakhs? It's pretty simple. After deducting rupees 12.5 lakhs from the total expenditure of rupees 45 lakhs, which was the expenditure incurred during this year, the expenditure for the current year will stand at rupees 32.5 lakhs and 85% of rupees 50 lakhs, which was the income for this year, comes to rupees 42.5 lakhs. Clearly the difference is the shortfall, which is rupees 10 lakhs. Now again you have to repeat the process for rupees 10 lakhs, which can be again accumulated under any of the two options we mentioned before. However, if in the previous year we had opted for option 2, then we had a period of 5 years for utilizing the same, and not necessarily the entire amount would have been adjusted in the subsequent year itself. In our next video, I will discuss in details about when the organization can avail both the options and compliances related to them. For any queries, you can mail us or comment below. Thank you.